right. Well, I guess it's time to introduce our speakers then. Um, I thank these two so much for jumping on here tonight. So we have Joe and Jessica from Primary Bank. So a little bit about each of them is Joe is the Executive Vice President and a Senior Lender at Primary Bank. And his partner in crime, Jessica Cabinate, I think it is. Cabenta. I'm sorry, I knew I was going to butcher it. She is the Vice President of Commercial Loan Officer of the Manchester branch. And together they do millions and millions in lending for commercial real estate. And I guess I'm going to pass it on to them to give more of an introduction of themselves, as they can probably do better than I can. So with that, I'm going to let you guys take it away.
Thanks, Joe. This is Joe Bader talking right now. And I know Matt's going to put up a short presentation we have. Really, we want this to be interactive. If you have questions, we're happy to answer them. We'll give you a little bit of information about the bank that I'll give you, and then Jess will give you a little bit about sort of what we look for in particular deals. In terms of a bio, I've been doing commercial lending for a long time in the Northeast market. Started in upstate New York and Syracuse. I'm a Syracuse alum, if there's any out there. We're all crazy. And I have 5 boys. So if it gets loud in my house, it's probably 1 or 2 or 3 of them killing each other, which happens on a pretty much nightly basis. So I'm just going to warn you that could happen. So with that, Primary Bank is a relatively new bank. We started in 2015, though the reality is we really started in 2009 and 10 in the economic crisis. In upstate New Hampshire, we found our founding fathers decided that they needed to start a bank because they were looking for capital and there was none. If anyone was around in the last financial crisis, they know that many banks, especially bigger banks, stopped lending, and they stopped lending to good customers, not even startups or younger people or other firms. And so a group of 5 individuals came together and said, we need to start a bank so that we can be open for people, especially in hard times. And our focus is solely commercial. We do no consumer lending. We don't make car or truck loans. We don't make home equity loans. We don't do, homes for people as their primary residence. All we do is commercial lending. From 2015, when we opened the doors with $30 million in capital, we had 400 initial investors pooled their money. We've grown to today to be a $500 billion bank or $500 million bank in 6 short years. And that's really because we've been active in the community. We've been doing a ton of lending. We've been getting good reception. And it was never more true than in 2020, which was, if you go back to the original founding of the bank in a financial crisis, we woke up in 2020, all of a sudden in a financial crisis. And what were we going to do? We had 2 choices. We could close up shop. We could, slow lending, or we could double down and help people, because now's the time when customers need it the most. Now's the time when our businesses need it the most. So what we did is got started. We modified loans that we needed to, and then PPP came around. We did $130 million in PPP loans, which for a bank our size is absolutely crazy, but it's a good thing. And so what that did is it gave us the opportunity to really help lots of businesses, and that did a lot of good for businesses. We are now in PPP 2. If you didn't get a PPP loan originally, now's your chance to get a new PPP loan. If you got a PPP loan originally, you can get a second one, as long as you meet certain criteria, which is mostly 25% revenue reduction over one calendar quarter, 2019 to 2020. Realtors count, investors count, and it's all based on your tax returns and people you may or may not be paying. Matt, I'm having trouble flipping the slides. Can you go to the next one?
Hey, Joe, while he does that, just curious, so is the bank entertaining business owners and investors and realtors that don't yet have deposit relationships there?
Yes. Yep. We are fully open for business. We do want to get, deposit relationships and loan relationships. And we've actually viewed the PPP as a great way to do it. What we found was a lot of non-customers went to their big banks who they were used to dealing with, and they found that there was not a person around that could help them. Because big banks don't have people that help individuals. They play the law of large numbers. And what we had were individuals who were actually making decisions, who were on the floor, who was talking to the SBA, who were talking to regulators, who were talking to customers and answering their questions. And so that's what we did, and that's what we will continue to do sort of going forward. And I think it's really one of the things that separates us from others quite a fair bit. We have the ability to make local decisions and make them quickly. A real quick tangent, a real quick story. We had a commercial restaurateur in 2020 buying a piece of real estate that they're buying the business and the real estate. They had been working for 9 months with their local bank. They were doing an SBA 504. They were also 1031ing out of a multifamily property, and they had a drop dead date on their 1031 of December 23rd. And they came to us on December 3rd and said, "Our bank's not working. Can you help us?" And I said, "Give me 2 days." And we scrambled around, and on December 5th, we said, "Yeah, we can help you." And we closed on December 23rd on a real estate acquisition, a business acquisition, and saved the customer $80,000 in taxes because they were able to do a 1031 exchange. And then because it's an SBA 504 and because we knew what we were doing, we did a 12-month short-term loan that's right now being refinanced into a more traditional 90% loan for an investment and an owner-occupied deal. And so they're going to recapitalize all their money to do another property. And that's because we understood what they were doing. They had the right people they were talking to, and we could do it internally and move things around to make it work. And that's really the advantage that small community banks give, because that's how we work. Jess and I can get in front of each other at any time and put a deal together, make a decision, get a term sheet out, say, do we want to do this? Go look at a property, and then move quickly. Matt, I'm having some trouble moving these slides. Unfortunately, wait, hang on, maybe I got it. As I was saying, we start with yes. We go to great lengths to help people. We understand the unique challenges because we've been doing it for a long time. I mentioned the PPP. We did 130 million in PPP. We did 180 million dollars in regular financing in 2020, non-PPP. Put them together, we did 300 million in financing. We're a bank of 33 people headquartered in Bedford, New Hampshire, with branches in Manchester and Derry. So that's really a testament to the people, the team that we've built, and the commitment we have to doing stuff in our community. With that, I'll turn it over to Jessica, who's going to talk to you about specifically what we do on the bank financing side. And Jess, I'll try to move the slides because I think I figured out how to do that as you talk through them.
All right, perfect. Hi, everyone. My name is Jessica Cabent, and I work for Primary Bank with Joe Bader. I followed Joe here to Primary Bank because of the community focus that Primary Bank has and what we're able to do for small local businesses, just like yours, in the multifamily area in the industry, basically. And so, what I'd like to talk with you about today, what part of what we want to talk to you about today is, are you ready for bank financing? Some of the things that Primary Bank does is, when it comes to multifamilies, and actually through the breakout rooms too, like, I think there's a lot of, questions that have come up. So, feel free to ask questions, when it's open for it. But, basically we basically do everything. We do every type of lending, provided that you're not living in the property itself. You know, we do purchases, 75% down. I'm sorry, 25% down, 75% lending on purchases, renovations and rehabs. We do refinancing, ground up construction, and long-term financing, you know, which is more or less the buy and hold piece of it. You know, we would typically do 70%. If you were to do ground up construction, we do 70% of the land purchase, 100% cost, up to 75% loan to value of the, you know, as complete value of the property. Our portfolio is, you know, we do a lot of, we've done a lot of refinancing and rehabs of multifamily properties in the communities that, you know, that we serve. So I cover the Manchester area in New Hampshire, and I feel like, you know, I've done a lot of, you know, 6+ families, you know, over the past year, you know, for there's rehab, refinancing, rehab, capitalization loans. You know, we basically, we do everything, and we'll work with you and make sure that, you know, you get what you need. And, you know, ultimately that, you know, we're giving you the best service, you know, possible. So, you know, Primary Bank's portfolio, you know, consists of, you know, construction loans, 1 to 4 family construction loans, for 1 to 4 family, loans in general. And, you know, I think a lot of some of the 1 to 4 family construction loans are smaller on our portfolio side, only because, you know, they're, you know, you build them and then they sell, right? So they're not going to be in our portfolio ultimately. You know, typically what the bank will need is, the bank would like, we want to see a couple years financials from you. We want to see historical cash flow. We want to see leases. You know, if you're doing any type of renovation, we'd like to see the budget. We actually need to see the budget, pro forma cash flow. You know, we'll need to make sure that, you know, we have an appraisal order, which takes about 5 to 6 weeks to come back, as well as possibly an as complete appraisal, which, when we're dealing with, you know, rehabs or any type of construction, you know, we want to make sure that we're able to lend that 75%, you know, loan to value of the as complete value of the property. Sometimes a property inspection is needed. You know, it depends on the kind of area. It depends on the area or in the condition of the property, that, you know, from, you know, what we're seeing when we do a drive-by. I think that there is sometimes there's a need for it. We would require an environmental questionnaire. That is actually required when, you know, for any loans that are under 500,000, we'll do a questionnaire. And then depending on the loan amount, the banks and the bank's policy in general, with Primary, you know, ultimately a phase 1 is a little bit more in detailed, a little bit more expensive, but it depends on the loan amount of it. I think it's $1 million that we need a phase 1 environmental done. You know, ultimately, you know, for financial purposes, we would need, you know, 2 to 3 years tax returns for the owners, for anyone who has got 20% or more ownership of the property, or the purchase, or of the project itself, whether it's a purchase or refi, whatever it is. Personal financial statement will ask for, as well as an application. And we would absolutely ask for your deposit accounts, you know, because, you know, in order for the bank to be able to lend, any banks to be able to lend, we need to have those, you know, deposits as well, to be able to, you know, offer some of the, you know, rates and services that we do provide to our local communities. So, you know, the process with the bank ultimately is, we're going to, you know, as a lender, so Joe and I are lenders, Joe's the EVP, but, you know, we're both lenders and, you know, by trade. So we'll look at the financial information, make sure it looks okay. You know, ask questions that we have just to kind of, you know, figure out if there's a deal there or not, and provide you a term sheet if it looks okay. Send it through underwriting, whether it's, you know, sending to an analyst here at the bank, or whether or not it's, you know, the lender, Joe or myself, writing it ourselves. You know, get an approval. The great thing about Primary Bank is that we have local decision making. So depending on the loan size, we can get a decision. I can drive, even though I'm in Manchester, Joe's in Bedford, 10 minutes away from me. I can go drive to Bedford, have them review a deal and sign it if it's under 500,000. And then if it's, up to, and then it combined up to, $1 million, it can be signed by the president and Joe. So it's just a good, Primary Bank is a great, the way we operate and how we approve our loans and, what our process is like, it makes it a lot easier than your typical larger institution where there's a little bit more process to it. So we're going to ask you all the same questions, but we'll make sure that, we get it all covered and get it in and done in a timely manner for you. So at that point, we'll get you an approval, hopefully, and, we'll send you out a commitment letter and, talk about closing at that point. The third party, there are a few third party fees that you'll have. The appraisal is usually, appraisals are a commercial appraisal for, a 6 unit can range anywhere from, actually these days, I feel like they've gone up a little bit, but, $1,500 to, $3,500 for a multifamily appraisal. The environmental depending, and that takes about, the appraisal takes about, I would say, 4 to 6 weeks to come in, depending on what bids come back and what you're willing to pay. If you're willing to pay more, we might be able to get it back a little bit sooner. And if you're willing to wait a little bit, we can kind of get it in a decent, in an okay time frame at a reasonable price. Environmentals will depend on whether or not your loan qualifies for a questionnaire or whether it qualifies for an environmental data record report, which is something we have to hire out for to one of our partners. That can usually cost between like $500 to $600. And then depending on if it needs a phase 1 environmental, prices increase from there and process changes as well. So the inspection report is something we usually typically ask for. Not typically, but depending on depending on the age of the property, depending on what work needs to be done, we would want to see an inspection report done. It'll let us know a lot of information. So if you're looking for any type of rehab, if you're looking for us to fund you the funds for the to fix it up and get it rented out again, then we can kind of add that into the budget and make sure that we're getting that our assets protected, your assets protected, and we're getting it to where it needs to be in order for this property to start generating some income for you. Title and closing, I feel like those pieces are appraisal and attorney fees, all third-party costs you're going to be responsible for as the borrower. Those are typically given, and those fees are typically paid at closing, but we do ask, banks will typically ask for a good faith deposit, which will cover a lot of the fees, and then the difference, whatever's not eaten up by appraisal and environmental and all that fun stuff, will be credited to your closing costs when it comes to the your attorney, our attorney, because if you're
So a typical good faith fee would be about $5,000 on a deal. It should cover all the costs of your appraisal, your environmental, any inspections, things like that, and some of your legal fees. On a simple transaction, you're looking at $5,000 to $10,000 in total cost. More complex transactions cost more. Jess was talking about some 6 families and above, some multifamilies where appraisals can get up there. But if you're doing a 1 to 4 family, it's a $500. It's a residential appraisal that we would use. We also have a service that does some for us that can turn things around in 2 or 3 days on smaller deals to fast track stuff when necessary as we move through. I've seen a couple of questions come through on the chat. That's a great way to send them if you have them. Not trying to hijack Jess's presentation, but there's been a lot of questions about sort of where we do business. And, Jess mentioned about the ability to drive to things. That's really sort of our sweet spot. We do business in Southern New Hampshire. We do business in Southern Maine. We'll do business in Northern Massachusetts, really anywhere in New Hampshire we'll go. We've done some stuff up north as well. We've even done a couple of transactions in Vermont, though not many. We've done a couple of transactions in Rhode Island, but not many. And those transactions are more following our clients. So if we have someone that's a client that lives in Manchester and is doing business, and we've done 4 or 5 or 6 loans with them, and their next deal is in Massachusetts or in Maine or somewhere else, we'll certainly look at following them. Or if we have a real estate broker that we do a lot of business with and partner with, we'll look at following somebody who's doing a deal, what you would consider to be further away from home. But certainly we're not looking to get on an airplane pre-COVID or post-COVID. It's really where we can drive and see, because we believe all real estate is local for our bank. And so that's one of the things that we do. Are there questions that we can answer for people? I think we've given sort of a good overview of the process at the bank. And my guess is there's going to be some people who want to ask specific questions, or, do you do this or do you do that? We'll certainly entertain those. I would say that.
I have a question. Do you guys do regular SBA loans?
Yes, we do. We do SBA loans, and we do regular commercial loans as well.
Great.
Non-SBA. So if we have real estate brokers, or someone that is trying to sell a property to someone that's going to purchase it and use it as an office space for themselves, for instance, or use it for their business, we can give them an SBA loan, which gives them really great terms in those situations.
This question was out there earlier in the chat, and I just thought I'd ask it as well. The seasoning for take a single family rental. What's your seasoning requirements?
Yeah, we don't really have seasoning requirements. One of the things that I think, makes us a little bit unique is that we look at every deal differently. We look at the merits of the individual transaction. Someone's buying an empty building, we can finance that if we think that that's, would lease up pretty quickly. If someone's, does a renovation and now has stabilized the property and is looking to refinance it out of a hard money loan or something like that, we can look at it. Generally speaking, we're going to limit how much we'll lend to how much you have into it. So if someone's trying to cash 100% of their cash out of a transaction, we might want that to season a little bit, but every deal is different and we'll look at it. We've done deals where someone's bought a piece of real estate, call a 4-unit. They've gotten rid of the tenants, they renovated the property, they've come to the bank, they now have new tenants in paying market rent, and we financed it at 75, 80% loan to value, and they've been able to take all their money out to do their next one. So we certainly will look at those situations. We don't have a specific. I think one of the things that makes us unique and better in many respects is we don't have a specific box that we say, oh, you have to season for 24 months, or you have to have this, or you have to have that. We sit down and say, does this deal make sense? Is this something that we think can be financed? Is this thing, does it work? And if it does, we'll certainly look at it. We've done deals where there's lead paint grants, remediation that gets counted as equity, or things like that, Main Street money. There are grants out there for some of these to betterment zones, and we've done things around those as well. Other questions? Jeff?
During one of the breakout sections, Mary was asking, I know we kind of got cut off, but an earned income, like if they're not showing earned income, how would they qualify for a loan? And I think that goes back to Mary. So for what, Joe was just saying is, if the deal makes sense, we're going to write it. We're going to help you out with that. And I think, we look at everything, but if there's a reason for it, and we understand it, the bank is willing to work with you on those pieces. So I wouldn't hesitate to look into it if it's something that you feel as though you think is going to be a good opportunity for you and that'll generate you some income. I think it's absolutely worth, looking into.
Yeah, we're going to understand cash flow versus earned income. We've been doing this a long time. I laugh at the political debates where, Donald Trump didn't pay any taxes. Well, of course not. He has depreciation. He has other things that go into it that limit, taxable income, but that doesn't necessarily mean cash flow. That doesn't necessarily mean income to an individual. So we're going to figure that out and look at distributions. We're going to look at what your actual true cash flow is versus what your tax return may say, and help figure out transactions.
I got a question. For the DCR, are you looking at 1.4 or is it closer to 1.5 right now?
We're 1.2.
1.2?
Mhm.
Okay.
Yeah, that's generally what we do.
All right.
Standard rack rate would be 75% loan to value, 1.2 debt service.
Now, is that more on the current or proposed NOI?
It really depends, and that's where it's a conversation. If the plan is to increase rents and do some other things, we'll look and make sure it works on the proposed. If it doesn't work on the previous, it might work on the proposed, because you're going to be increasing rents. We have a good handle because we're in the market every day what market rents are. If you say, hey, I'm going to get $3,000 a month for this unit, and we say no, market rents are $1,500, we're going to discount you. But if the tenant's paying $800 because they've been there for 12 years and the previous landlord never did anything, we'll let you take those rents up to $1,500 if that's what they are. Or you're going to put some money in and you're going to spruce up the kitchens and you're going to be able to increase rents by $300. That's stuff that we do every day.
Oh, okay. So you don't have to go by what's current for the rents right now. You can look at okay, that's good to know. And are you still looking at a capital reserve of 5%, the vacancy rate of 3%, and the management fee of 5% for a total of 13, or is that changing at all?
Yeah, more or less. I mean, those numbers move around a little bit, but the total's pretty accurate there. It might be 3% management, but 5% vacancy, things like that.
And that's even if they're planning to self-manage? You still?
Yeah, we put it in on an underwriting, but when we actually test the covenant, we're testing it based on actual. So it doesn't really, you don't get hit with that. We're going to look at the tax return at the end of the day. And we're going to be realistic with that. So if you're managing it yourself, but you're paying yourself a 10% management fee because it helps you from a cash flow standpoint and reduces your taxes, we're going to look at and say, yeah, but we can manage this for 5%. So we're going to take that non-recurring or sort of above market and add that back in when we figure the cash flow.
All right. Thank you. That helps because looking at some of these multis on the market in New Hampshire, I'm in the New Hampshire market. We were told someone mentioned that the DCR right now is 1.4 to 1.5, and to make some of these deals, the numbers don't.
They won't work on that.
They won't work. Not with the price per door right now, and it's just crazy.
Yeah. And that's not, we've never been that.
Okay. Well, thank you. That helps. Thank you.
I have a question. Can you hear me?
Yes.
I'm only familiar with residential loans. I'm not so familiar with commercial loans, like on a 5+ unit building. But I'd like to be more familiar in case I go in that direction. Could you basically describe the difference between a residential loan and a commercial loan for like a 5+ unit building?
Sure. A residential loan, you're going to make, you can get 90%, maybe even higher financing. It's yourself that they're underwriting more than the cash flow. And it's something that could likely be sold into the secondary market. So it's going to be very strict in what they can and cannot do. When you get above 4, and that works for 1 to 4 family. When you get above 4 family, you hit 5 units or more, you go into commercial. Once you go into commercial, it's a whole different regulatory environment. We're going to underwrite to a max loan to value of 80%. We can't go above that regulatorily. Most banks will be 75, 80% on a great property. You even a little bit lower, maybe on a bad property, 70%. But what we're going to look at when we get to those larger properties is the the property has to be able to support the debt. So we're really going to be looking at the tenants paying rent, the cost of operating the building, and the cash flow that's going to be provided. Because as loans get bigger, the feeling is, from a bank standpoint, is you don't have the ability, most people don't have the ability to write $1 million check, but most people have the ability to cobble together $5,000 or $10,000. So on smaller properties, you can make your mortgage payment by picking up a second job if you have to, if you lose a tenant, right? You can move into a unit if you need to help make ends meet. But once your loan gets so big, and as you get more units, it's a lot harder to do that, because if your monthly payment's $10,000 or $20,000 a month, it's a lot harder to cover that than if it's $1,000 a month. So that's really where the difference comes into play.
How about the difference between like rates and terms? Like these days, you can get like a 3% loan on a 30-year note. Where would you go if there was a commercial loan these days?
Right. Commercial loans don't get written with long-term rates like that. They typically get written with 5-year adjustables. Sometimes you can get 7 years. Where we're pricing things today is between 4% and 5% for 5 years. We'll give you a 20-year term. We'll give you a 25-year amortization, but your rate's going to reset every 5 years. At the then, Federal Home Loan Bank plus 250, say, sort of as an average margin. And that's pretty much the market. And some banks will even go shorter. They may only give you a 10-year term or a 5-year term with the thought that you're going to refinance it at that point in time. Much like the residential market, the market knows no one holds these assets for 20 and 30 years, or very few people do. So to lock up capital for that period of time just doesn't make sense, because you're going to be refinancing it, you're going to be selling it, you're going to be flipping it, taking advantage of lower rates, or taking cash out if there's appreciation of value. So we know that it's not going to be out there that long. So it doesn't make sense to do long-term financing like that.
So as an investor, if you're buying a 5+ unit building, but hoping to hold it for 10, 20 years, how would you think about how to forecast dealing with a loan that resets in 5 years?
Yeah, you're going to look at how much money you're going to be paying off over the first 5 years. You're going to look at historic rates. I mean, I can tell you, I've been in this business since, I've been in this business since the early 90s. And from that time to today, I mean, there's never been more than a 2% interest rate fluctuation at any given time. So you could look at, sort of worst case, you can go back and look at historical rates and say, what's the worst case my rate could have been? What's the best case my rate could have been? Generally, they're relatively, within that 2% margin. So if you're in 4 now, you might be in 6, 5 years from now. You could also be in 3, 5 years from now, when rates reset. It all depends, but it's not going to 10 or 20. Or it certainly hasn't been in the last 40 years.
Okay, thank you.
Any other questions?
Check the chat. There's some questions there.
Yeah, Joe,
Yeah,
I'm seeing a
Yeah.
question on here. It said that, I've heard from Donna that they've heard some lenders have higher reserve requirements now due to COVID-based cash flow risks. Have our requirements increased? They haven't. I think it's a case-by-case basis, similar to what Joe had said before, Donna, where, we're going to look at the property, and I think we're just going to look at it really all depends on how everything looks. It depends on what the transaction is. It depends on if it's it really all depends. And when we do look for reserve requirements, we'll typically look for about 6 months if that is required, but it's not something that we always do require. So I hope that answers your question.
And the interesting thing about it is, in March of last year, when, all of a sudden everyone was locked up at home, you couldn't evict people, no one was going to pay their rent, every business was going to fail in America. That was sort of the fear, right? that's what happened. And we were working with all of our clients. We didn't increase reserve requirements. We actually moved people from principal and interest to interest only, to help, bridge that gap. We gave some people full payment deferrals. And then we waited and saw what happened. And what happened was, the federal government jumped in with PPP, got people back to work. The federal government jumped in with stimulus checks to people. And we talked to our holders of real estate, our holders of multifamily units, and said, what's happening to your units? And they said, everybody's making their payment. Everybody's paying. Or, I might have one or two, but that person wasn't paying well before COVID hit, So, and we didn't need to do it. And so because of that, we learned there is no reason to just blanket say, oh, we need more reserves to everybody, because we don't, because people are paying their bills, and that's how we look at it on a case by case basis. And that's why we look at it on a case by case basis. And it's where, when you're dealing with the decision makers, it's a lot easier to do that because we're on the ground and we're talking to the people, so we know what's really going on. When you're dealing with, I'm going to pick on Bank of America. I always love picking on Bank of America. Bank of America is in Charlotte. They have absolutely no idea what's going on the ground in Manchester, New Hampshire. None whatsoever. Even in Boston, there are banks in Boston that widespread sloth said, everything in their marketplace is exactly the same. Well, a restaurant operating in downtown Boston is nowhere near the same as a restaurant operating up here in New Hampshire, because they're not shut down. They're not, they might be limited, but they're limited to 50% capacity, not 10% capacity. There isn't curfews. So the performance is totally different. And we see it, so we can make decisions that make sense versus someone who's making a decision based on fear because they just see a small part of the country.
There was another question on here.
There's a couple new ones in there if you want to check that out.
There's another question. I think I missed one. It says, some of the deals are commercial from, oh, forgive me for not pronouncing your name correctly. Hold on a second. Nirajan. Some of the deals or commercial properties are overvalued on acquisition side. For example, on new construction projects. How do you calculate the loan to value for the loan? We typically will calculate, and that's a case by case too. So not case by case, we will only go 80% loan to value max, like Joe had said earlier. But we rely on a commercial appraisal company to do either an as is or an as complete appraisal for you, and the loan is basically approved on a cap of 80% or 75% based on the actual property itself. So I guess I think whether or not they're overvalued or not, I think it's definitely something. Well, I don't know, Joe, what do you think about that? I feel like appraisals have been coming in a little bit differently too during COVID. So that's kind of a hard question to answer, because I know there's a little bit more to it than just what's being asked.
Yeah, I think if I understand the question, and feel free to correct me if I don't. If the question is if I'm buying a property with a plan to add value, how do you handle that situation? And the way we handle that situation is we get an as is value and we get an as complete value. So the appraiser goes in and says, okay, the property's worth $100,000 today, but I know, because I talked to the guy who's buying it or the woman who's buying it, that they're going to go and redo all the kitchens and baths. They're going to increase rents by $500 a unit. And when they finish that project, the value of the building now is going to be $150,000. So we'll give you a loan where you get money today based on the $100,000, but you get effectively an earnout. You get to recapture that money based on the now $150,000 value at the end of the day. That bridges the gap to get you there.
Perfect. Trying to see what other questions there are.
Construction loans, I see. We do those. We tend to float, prime plus one, prime plus two during the construction period, interest only during the construction period. You draw money as you need it, as you're doing work. And then once you're stabilized, get your tenants in place, then you flip to more traditional amortization.
And on portfolio loans, if like for the example given there in the question about 5 single family homes, we do look at portfolio loans. It really all depends on the portfolio itself. The options are pretty, I think, standard as to any other, commercial loans that we offer. When it comes to portfolio loans itself, I guess it really all depends on, what you're looking for, what your plan is, what your ultimate goal is at the end of the day, because we can truly structure something to, fit your ultimate need.
We're doing one right now, 14 properties and 6 towns. And one of the things is they plan to sell some of them. So we built in a formula that says, as you sell one, you make a pay down based on X, Y, and Z, and it just reduces your loan and keep on going. So we can do those.
Does anyone
I
else?
think the biggest key is,
sorry.
I was just saying, I think the biggest key is, sit down and talk to us when you have a transaction, and we'll figure out the right structure and the way to make it work.
Are you seeing more issues with inspections right now? Like deals falling apart because the items that come up in the inspections, like safety issues or needs new roofs and stuff like that?
I mean, I feel like we had one recently that it's not, I don't feel like we're losing deals because of it. I just think that it depends on the property that you're purchasing, if it needs a lot of work.
Yeah, it seems like the one
it doesn't fall apart because of us. Recently. It falls apart because of you more than anything else.
Yeah, like some of the ones.
If you get an inspection that says there's a lot of work, we'll figure out how to get the work done and structure a deal with you to do that work. If you are afraid of the work or concerned about it, then you're more likely to walk away from it than us, because we're going to figure out how to structure it.
Oh, okay. So I was wondering, like, if the property needs like $100,000 worth of work and you're already at like your DCR, and then that adds almost like to the price of the home, does like the deal fall apart at that point?
It all depends. I mean, it could. It all depends on what the work is and if the work adds value. If you need a $20,000 roof, does the $20,000 roof add $20,000 of value on the property? Probably not. So that's where you're going to be going back to your seller and say, hey, listen, you're selling me a property with a roof that needs to be replaced. You need to take something off the purchase price to make it work, or repair the roof before I buy it. If it's something where, you're going to go in and do kitchens and baths, then you're going to get value out of it. You're going to replace windows. You're going to get value out of it. So those things take, just get factored into it. It's more likely that you're not going to do the deal than we're not going to do the deal.
All right.
In that regard.
That's encouraging. Thank you.
The bank you're working with also is not going to put you in a position that's going to set anybody up to fail. So I think one of the ways, working with a, community bank, just really staying in communication with your lender, making sure that they understand everything about what you're looking for is super important. Communication is key in even a lending situation. And I feel like, if we feel as though like we can be part of your team, right? So you've got your attorney, you've got your broker, you've got, your accountant. We work with tons of people. We work with many different brokers, many different accountants that we can, if you're in need of one, we can kind of work with you to get them, get you connected with them. And we're not, we're ultimately out there. Any bank should be truly out there for your best interest and the bank's best interest too, right? Because we're holding the asset, right? So ultimately, we want to make sure that it makes sense for you and it also makes sense for the bank. So we're going to be completely upfront and honest with everybody as well.
I'll jump in and share my experience. We had a refi of a 6-family building in Manchester, New Hampshire, and there were a lot of we have relationships with a bunch of banks, and every single one of those banks, I guess we could have. I chose one that I had a relationship with already, And it was funny because despite the fact that we had all these business deposit relationships with them, and I won't say the name, but it was they had a very strict box, right? And what we were looking for, they had a product for us, but it wasn't the product we wanted. It wasn't the product we needed and we're looking for. And it was refreshing because we went to two of our lenders first just to see what the options were, and then I randomly got an email from Jessica Binta, and Jess and I go back, to 2009 with like 4 or 5 companies ago. And it was probably the most refreshing conversation because you're all hearing this now. And for a lot of you, it might anger you. Oh, case by case deal by deal, like, depends on the project, but it's truly, they start with yes. It was literally like, oh yeah, we can figure that out. Like it was exactly what we wanted, exactly what we needed. And despite the fact that I was like, no, I don't believe you because every other bank has strict boxes and strict criteria. And I was bothering the crap out of her pretty much every other day saying like, you can't do this loan probably, right? You can't. It's okay if you can't. It's okay. Just tell me because I can go somewhere else. And she's like, no, we're good. We're good. Like, and Joe, in his department. So they are a refreshing breath of air, especially in this environment. And I guess I wanted to kind of throw my 2 cents out there because the case-by-case basis is truly does this make sense financially? And how can we structure it so it makes sense? They're a team player. They're not just a bank that's going to red stamp or deny you or approve. They're going to try to figure it out. And if they can figure it out, great. So just want a huge kudos. Breath of fresh air right now in the market, especially now post-COVID. Thank you, Joe.
Thanks, Nick. That's definitely true. We're here to get deals done. My business card in the back says we start with yes, we're creative, we're entrepreneurial. I said earlier, we did 186 million in commercial financings in 2020. Not many banks can say that. A lot of banks were shutting down. A lot of banks were going other places. We had a record year in new loan originations, and not just a little bit. We had a record year by 50%. We grew our portfolio by 45%. Those numbers are unheard of in banking business, especially in a downturn where most banks were looking how to not make loans.
Perfectly said. Congratulations, you guys.
Thanks, and thanks for having us. We're happy to be here. If anyone has any questions, our contact information's on the end of the slides. I'm sure reach out to either of us, and we'll see what we can do to help.
Thank you.
Yeah, and thank you guys for coming on. And this presentation will be recorded. So for those who missed part of it or couldn't be here tonight, we want to share this out to other people you know. I believe it'll be posted on our Facebook group. So make sure you go ahead over and join that, as we talked about in the beginning. But yeah, Joe and Jessica, thank you guys so much for coming on. This has been a year in the making. So Joe and Jessica agreed to speak at our March 2020 event. And we were all set to go. Everybody was all excited, and that never happened. And so here we are almost a year later, and you guys are here. And I can't thank you enough. This is awesome.
We wouldn't have gotten to hear such a great success story if we did this last year, March. So
that's
the
true.
delay was
Thrilled
worth
to be.
That's so awesome.
Thanks.
And
Frank.
yeah, if anybody has their contact information, and if you guys are looking for their contact info, we'll post it up in the Facebook group as well. And does anybody else have any questions before we wrap this up tonight?
Short and sweet meeting. I didn't realize it would only be, an hour or so with commercial financing post-COVID, but they're to the point.
They did an awesome job. Awesome. So again, I guess we'll just reiterate. So I want you guys all to join us next month, where we're going to have the multifamily versus single family cash flow debate. It should be a good one. Again, that's on February 20. What day is that? February 24th, I think. Find my notes here. Yeah, February 24th. And
Oh, you know what, Joe? I'm going to just jump right in with another question. Can I have one more question? Sorry.
Again.
I know I'm like ruining the whole end flow of this meeting, but I'm seeing another Alan Allerud over there with my last name on it. I think he has a burning question that he hasn't asked yet, so I'm going to ask it for him. Joe and Jessica, how do you feel these days on retail, office, or restaurant financing?
Question.
It's a great question. We've certainly done a fair bit of restaurant financing this year during COVID and coming outside of it. I opened with the December story, which was a restaurant financing that we did. And Jess is closing next week on a sizable retail transaction in Bedford, a strip plaza that's actually still open and operating. And we did a mall or an outside mall up in the Lakes region earlier this year on a transaction that we did even during COVID. So we are looking at it. Office is a little bit more scary, but it's just understanding, who the tenants are and what the need is there. But yeah, we're open for any type of transaction.
That's cool. That's different than the other answers that he's getting. I think we're getting from other lenders on office and hospitality, especially. So very cool. Sorry, Joe, I didn't mean to jump in. February 24th. Continue.
No, that was a great question because those are the industries right now taking a beating. So that's a great question for sure. Yeah. So February 24th is our next multifamily meetup meeting. It'll be virtual at this point. If it can be in person, we're going to make it happen, but we'll see. But at this point, let's just assume it's going to be virtual. And yeah, mark calendars. We'd be glad to have all you there. Again, the whole point of this group is to meet like-minded individuals and network, and to just build a better community of real estate investors and people who really care what they do and the communities they affect. So I appreciate you all for coming here tonight. Again, please be sure to join the Facebook group tonight. And yeah, if you have any questions at all or want to reach out to me at any time, feel free to send me a message and I'd be happy to connect with you and have some coffee or whatnot and do business. So if there's anything else from the team, I think we can all say goodnight. All right.
Have a great night, everybody.
Thanks a lot.
Everyone, thank you, Joe. And sorry, thank you, Joe and Jessica again for coming on. And we'll talk to you guys later.
Good night.
Thanks a lot.
Good night, everybody.
Thank you.